Carrier. Indigo Airlines is all ready to take off on the Lal Street. The company is geared to raise between 3,077 to 3,245 crore rupees through an initial public offering that commences on the 27th of October. But the pricing of its IPO, its corporate practice when it comes to the dividend policy or dividend payout, and a closer look at its financial statements have raised some concerns. Sonia Shenoy Farah Bookwala get you the details.
Indigo Airlines has a strange story to tell. By its own admission, it needs no cash. Yet, it is approaching the capital markets to raise funds. Despite sitting on a net surplus cash of more than 3,600 crore rupees, garnered over 7 consecutive fiscals of profitability, it aims at raising the same quantum through its IPO. This begs the question, why approach the capital markets when you can fund your own growth?
In any organization, there is a certain milestone that you have to come to, where it creates that legitimacy, if you will. It creates that bigger, as you said, brand and so on and so forth. For me and the management team, that rigor that comes in, irrespective of what we try internally today, that rigor that comes in from being a listed company is incomparable.
Market experts argue that the IPO, which is priced aggressively at 700 to 765 rupees a share, gives the company a market capitalization of 27,000 crore rupees at the upper end of the price band. But Indigo believes the valuations are justified given that the company has grown at a compounded annual growth rate of 38% and has a predictable growth trajectory for the next 3 to 4 years. But what has the market's disapproval the most is Indigo's dividend policy, which is raising questions on the company's corporate practices. After 7 years of positive net worth, Indigo's net worth slipped into the negative territory in the first quarter of fiscal 2016. That's because just ahead of its IPO, the company has pulled out 1,003 crore rupees from its reserves to pay an interim dividend to its promoters. Ghosh dismisses this as a non-event.
It's a non-event. And I know it's going to sound a little bit flippant, but it is a non-event.
Okay.
The negative net worth is on that day as of the 30th of June. First of all, the cash starts generating again. So the negative becomes positive.
Okay.
We've never had a negative net worth year, and this is our most profitable year. So, put 2 and 2 together and, that will give the comfort.
But this dividend policy points to a larger issue. Since fiscal 2010, Indigo has paid a cumulative dividend of 3,700 crore rupees to its promoters, when total profits earned, excluding MAT credit, was 3,441 crore rupees. This means the promoters have drawn out 260 crore rupees more than the earned profits of the company from its books. Not to forget that the 1,900 crore rupees raised through the offer for sale of 2.61 crore shares will also go to the promoters. The company's decision to pay dividends to existing shareholders instead of paring down its debt of 3,900 crore rupees is raising eyebrows. Indigo's Ghosh says that the fresh issue of 1,166 crore rupees will be used to pare down some debt, but Indigo will strive for a balance between debt and equity. More importantly, the dividend policy will continue.
We've always taken a very pragmatic approach. We've been shareholder focused and at the same time done whatever is right for the business. And that view is not going to change going forward.
But this argument may not cut ice with investors. Many believe Indigo is compromising on the smooth landing of its IPO. In Mumbai with Sonia Shenoy Farah Bookwala, Vora.
All right, that's the mega IPO. Indigo all ready to take off. So watch out for that one. But here's